the real anxiety, the real rush to bank consolidation begins. And my prediction is we see that here by the beginning of the fourth quarter or the end of the third quarter. So lots happening, lots accelerating, and we are not out of the woods yet. What we are is in the most advantageous position I have seen in 3 years to buy gold and silver. We are in the eye of the hurricane here, and the worst of the storm has yet to hit us.
The International Monetary Fund, IMF, is working toward developing a platform for central bank digital currencies, CBDCs, that could enhance transparency and make cross-border settlements cheaper and easier. One big difference between CBDCs and cryptocurrencies is that central banks control the former, while the latter is highly decentralized. Emphasizing the need for asset-backed CBDCs, IMF Managing Director Kristalina Georgieva said cryptocurrencies are an investment opportunity when assets back them, but would otherwise be a speculative investment. CBDCs have the potential to promote financial inclusion and make remittances cheaper, she said, noting that the average cost of money transfers stands at 6.3%, amounting to $44 billion annually. Regarding the role of gold as an international reserve, Andy Schectman, CEO and president of Miles Franklin, in his recent interview with Liberty and Finance, referred to a report released by the IMF a few weeks ago. The report questioned the role of gold as an international reserve, labeling it as a barbarous relic. Schectman noted that gold has been reclassified as Tier 1 by the IMF, which means that it is considered to be a high-quality reserve asset. The report states that in the third quarter of 2022, global central banks added US $20 billion of gold to their international reserve portfolios. This was the largest quarterly increase in official gold demand in fully 55 years, according to the World Gold Council, 2022. This startling increase excited much commentary, taking place as it did against the backdrop of a secular decline in the share of global reserves held in the form of gold stretching over the better part of 4 decades. In fact, this increase in official gold demand is not as unprecedented as sometimes portrayed. Schectman also highlights a report from 2010, released at the United Nations Conference on Trade and Development, which advocated for abandoning the US dollar as the primary reserve currency. The report says that developing countries have been hit by the US dollar's loss of value in recent years. The report supports replacing the dollar with the International Monetary Fund's special drawing rights, SDRs, an international reserve asset used as a unit of payment on IMF loans and made up of a basket of currencies. Now let's watch excerpts from Andy Schectman's interview with Liberty and Finance. Be sure to watch the entire video and consider subscribing to our channel. Don't forget to enable post notifications to stay updated on our latest uploads. Thank you and enjoy the video.
We saw the IMF came out and said they are working on a global central bank digital currency platform. And I find it interesting that our favorite IMF head, Kristalina Georgieva, who a few weeks ago came out and said that the problems with the bank failures had to do with people's ability to move their money with the click of a mouse, that needed regulations applied to it, that people shouldn't be able to move their money that quickly. Well, now she just came out and said that CBDCs need to be backed by assets in order to make them not speculative. Now think about the report the IMF issued a few weeks ago. What did it say? Gold as an international reserve, ? A barbarous relic no more. All right? So we know that gold was reclassified Tier 1. The IMF, the head of the IMF is saying, well, any CBDC needs to be pegged to currencies or to a commodity. Wonder why they would say that. Do you think it has anything to do with the announcement that on August 22nd, the BRICS plan on rolling out their new commodity-backed currency? I wonder. Maybe, maybe not. I'm not sure. But nonetheless, this is coming from the IMF. This is the second most powerful bank in the world, and it is something to certainly not take for granted. I want to give a shout out to the Gold Telegraph. They are a Twitter channel that has information, I don't know, second to none, and I think they deserve a shout out. And they talked about a report that I remember very vividly, but have forgotten about. And the report is quite interesting. It was written in 2010, and it was released at the United Nations Conference on Trade and Development. And the report at this point advocated abandoning the U.S. dollar as the primary reserve currency, which, by the way, is also, as we've talked about, the general thesis of Jared Bernstein, the head economic advisor to President Biden, relinquishing the dollar as world reserve in his mind because of the distortions and economic imbalances that it creates. Well, the UN says the exact same thing in 2010, and they said the report proposed a global reserve system based on a basket of currencies rather than solely depending upon the U.S. dollar. Well, again, does this sound familiar with what we are seeing with the BRICS and now what the IMF is talking about? And their objective in the report was to create a more stable and predictable international monetary system. Well, maybe that's why Christina talks about pegging it to commodities, because we've seen with cryptocurrencies, if you don't peg it to something, in the case of Bitcoin, you can use it to buy a pizza, and by the time you're done eating it, you could have bought a Rolls Royce with it. Now, I'm being somewhat tongue-in-cheek, but what it talks about is the volatility found in things that are not pegged to something.
During the interview, Schectman also pointed out the significant gold acquisitions by countries such as China, India, Turkey, Egypt, Qatar, and Singapore. These acquisitions highlight the importance of gold to these countries and may incentivize them to move away from the current system. The Global Financial Stability Report shows that risks to bank and non-bank financial intermediaries have increased as interest rates have been rapidly raised to contain inflation. Historically, such forceful rate increases by central banks are often followed by stresses that expose fault lines in the financial system. In its role of assessing global financial stability, the IMF has flagged gaps in financial institutions' supervision, regulation, and resolution. Previous global financial stability reports warned of bank and non-bank financial intermediaries' strains in the face of higher interest rates. Schectman states that, by the end of this year, we are going to see a lot more stress in the banking system. Let's get back to the interview.
There are signs that are becoming too hard for people to ignore. And when you see these types of changes, and when you see massive gold acquisition by countries like China, India, Turkey, Egypt, Qatar, Singapore, all of these countries adding to their gold reserves, and all of these countries involved in either the Belt Road or the BRICS or the Shanghai Cooperation Organization, you can see what is important to these countries. And I think, what is happening here in this country, I think, is rapidly becoming incentive for a lot of these countries to move away. One last thing I want to talk about is a pushback between capital standards that the Basel Committee on Banking in 2017, I guess you could call this Basel III, these major regulatory proposals that need to be put through, the banks are pushing back against. And the U.S. Federal Reserve is finalizing this proposal, which would implement these mandates. And they're talking a lot about higher capital charges on non-interest revenue. And that would be things such as fees or credit cards or late fees or overdraft fees. And anyway, in any case, the rules want to maintain a much higher capital charge for money that is listed as, or a capital requirement for stuff that is listed as these capital requirements, these non-interest capital expenditures. And the banks are pushing back against it because they have virtually nothing in the way of reserves. And I guess what I take away from it, when the banks are pushing back against these standards being tightened, it just simply tells me that we have not even begun to see the end of the problems with the banking industry. And I think quite to the contrary, I think it is, I think by the end of this year, we are going to see a lot more stress in the banking system, a lot more. And you can see by almost $100 billion right now in this new emergency lending program that we are not out of the woods yet. So people who think we're out of the woods and that we are on the heels of a new stock market boom and we're going to get a soft recovery, I think or a soft landing, I think are going to be very sadly mistaken. And if I had to bet, as we approach the fall, and as a lot of these new, a lot of the commercial real estate loans reset and have to reset from a 3 or a 4 year ARM to rates that have doubled, you're going to see massive strain, not only in the commercial real estate, but the small businesses, all of which is 70% controlled by the small regional banks. And I think this time the difference will be Janet Yellen will let them fail. These people will be recognized for what they were supposed to be at the end of the 2008 financial crisis, and that is unsecured general creditors.
In recent years, there has been an increase in the share of gold in global reserves as central banks are leading a revolt against the US dollar and shifting to gold. However, there have also been some signs of renewed interest in gold, as investors have sought a safe haven asset in times of economic and political uncertainty. What are your thoughts on the interview? Do you think central banks will continue adding gold to their reserves in the future, or will they eventually switch to CBDCs? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.